Hey, Alex.
Hi, Kiah. How are you?
Oh, I'm good. Well, we've got a couple of topics to talk about today, not about my Fed bank field trips. The first one that I wanted to talk about is not necessarily one piece of news, but many, many news items that I think thematically fit under a topic that I'm calling Banks Love AI or AI Loves Banks.
Mm-hmm.
And I think this is really interesting in part because if you had to go back like 3, 4 years ago, whenever like that one ChatGPT model came out,
Yep, 2022.
yeah, it 180 change between on banks with like because that's not when AI started. There were many different types of AI technologies
Totally.
available to banks. They just kind of didn't look like generative AI. They were, more of the flavor of RPA and machine learning. And I think there are good reasons why those technologies were not widely used at banks. It was more rigid, it felt like. The data that banks could use, the use cases, it was just a little bit more complicated. And then generative comes out and banks were both like scared and excited in a way that I think that the fintech companies were probably mostly excited.
Yeah.
And now we have seen so many announcements coming out around this like AI plus banks. So I'm going to list off a couple and then we can talk about them. So we have the FIS Anthropic announcement. And those banks that are going to be working on that are BMO and Amalgamated. Pfizer just announced Agent OS, an agentic AI operating system. They will be working with 6 institutions to co-develop Agent OS. And really interestingly, and I think really telling for a core, Agent OS is expected to be widely available by August 2026. And I had to like really quickly look up what year it is because it's also actually 2026. And so you're telling me that in a couple of months, like 4 months, 5 months, this is going to be available. Customers Bank is partnering with ChatGPT to help OpenAI and ChatGPT like understand their workflows and work in commercial lending and commercial deposit opening. There's Mythos, which is its own, threat. Banks are right there with it. Regulators are trying to publish something about AI models, but it's not their existing model risk management. And then you included in here some other items like Affirm saying that they were using transformer models in underwriting. The regulators are starting to include more explicit discussion about AI, both in their regulatory risks and expectations, and then in the surveys. And so, Alex, I just wanted to know, like, what's going on? What's your take? What are your thoughts? And what are you most interested in among these announcements?
Yeah, I mean, I think the point you made at the very beginning about how banks are reacting to generative AI and large language models as opposed to how they've reacted to almost every other technology that's come in the past is pretty interesting, right? Because
every other,
like I'm old enough to remember cloud computing. I'm old enough to remember mobile banking when it was a novel concept in the financial industry. And it's funny because in all of those prior waves of technology, as you said, machine learning, gradient boost models, like every subsequent wave of technology tends to hit banks the same way, right? Which is the biggest banks pay attention pretty quickly. Fintech companies or non-bank competitors use the technology to get an advantage. And it ends up being something of a struggle between big banks reacting to fintech companies or non-banks and kind of the competition between them. And then the rest of the market kind of gets dragged behind the boat slowly, right? And, the core discussion is so interesting because the cores are sort of infamous for slow rolling new technology out to their base of customers over a long period of time, right? Like, if you're Bank of America, you get mobile banking day one. If you're a tiny little bank that's relying on Fiserv, you'll get mobile banking when it's ready and don't worry too much about it, right? And a lot of community banks or regional banks, when you would talk to them, they would be like, we don't need that. Like, why does that matter? How does that affect our business? Like, I can't tell you how many conversations I've had with community bank executives where whatever the topic is, cloud computing, machine learning, alternative data, mobile banking, remote deposit capture, OCR, whatever it is, they're like, like that relationships. We do relationships. This isn't anything to do with that. Like, who cares? This is the first time in my career that I've seen banks as a group, including the core providers that serve them, everyone, big ones, small ones, medium ones, they all universally are like, we take this extremely seriously. We are going to immediately have a story about what we are doing in this space. We are immediately going to leap into this space. And, I think the announcements that you've seen from the cores reflect that sort of all-in urgency from every bank, right? I think if I had to guess, like, I would imagine FIS, Fiserv, Jack Henry, all these providers, their phones must be ringing off the hook from all of their banks at all times, being like, hey, what are you doing? What can we do? I think they get asked about it just constantly on earnings calls. So on one level, I'm not really surprised that this volume of announcements has happened. I think it has sort of coalesced at around roughly the same time that we started to see some real traction with agentic AI. So all these announcements are very like agentic in nature. And just as a quick bit of context for listeners, agentic as kind of a concept really gained traction with Claude code capabilities, which really started to impress people in the software engineering space last fall, right, with the release of one of Anthropic's latest models. And so it's really only recently that we've sort of seen what the playbook looks like for enterprise adoption in AI, which is a strong foundation model paired with the harness and the software that they wrap around that model that makes the agentic AI spinning up agents thing work, right? And we've seen the most traction with coding, but we're starting to see the development of other types of harnesses and other types of systems that can be used for other workflows that aren't coding. And obviously, if you're thinking about it from a Anthropic or OpenAI perspective, and you're like, okay, where's a space where there's lots of manual work, there's lots of really hyper-specific workflows that have these very sort of specific steps, many of which might require sort of human-like judgment or appreciation for nuance or ability to handle complexity or unstructured data. Financial services is going to come up right towards the top of that list. And, Anthropic actually said in one of their announcements that financial services after tech is their next biggest vertical and represents like 40% of their top 50 enterprise customers. So all of the AI labs are like, we have to find a way to serve financial services. And so then the question that you have to ask yourself is, all right, well, what's the best way to do that? And I think the challenge for OpenAI and Anthropic and Google and whomever else is going to be participating in this market, the challenge is coding is relatively straightforward because all of those companies know software engineering. They understand the workflows. They have huge teams that do it, that can kind of test out what they're building. And by the way, the other thing that's nice about coding and software engineering is it is sort of deterministic in the sense that like I'm writing code, the code is supposed to do this thing. I can then test the code to do that thing, and I can see, did it work or did it not? And if it didn't work, I can debug it and find out why it didn't work and then go fix it. So the inputs and outputs are relatively deterministic with coding. And so it's not surprising to me that agentic AI found its first real use case with software engineering because the people who are building the models are familiar with software engineering, and the process itself is really deterministic and easy to test and easy to build around. When you want to sell to financial services, the two problems that you have are, one, financial services is less deterministic than coding, right? There's nuance, there's judgment, there's regulations, there's just best practices, there's weird things that aren't just like something in, something out. So that's one challenge that you have. And then the second challenge you have is no one at Anthropic knows how commercial lending works, right? No one at OpenAI knows.
How hard can it be?
Yeah,
Come on.
like KYC, how hard could it be? Well, it turns out it's actually really hard. And there's these really hyper-specific workflows and processes and guidance and rules and policies and committees and just all of this shit that is really hard to learn from the outside. So all of these announcements in varying degrees all involve the AI labs putting their engineers inside banks or inside the core providers. So they are embedding their engineers. Literally, they are going to go sit in the offices of these companies that they're working with.
Sausage making, like
and they're
the
going to
sausage
look
making.
right over their shoulder and be like, so KYC, how does this work? Explain this to me. And What they're going to do is they're going to learn these workflows and then build AI agents to specifically help speed up, improve, make more efficient these workflows. The benefit in the short term will accrue to whatever banks are like doing the pilots with these. So amalgamated, BMO, customers, what have you. But my expectation, and the reason that the AI labs are doing this, I think, is that will then become a productized AI agent or system of agents that those AI labs can then sell to all of the other banks in the country. And not only that, but they'll have built-in case studies that they can take with them to help make that sale easier. So I find that model particularly fascinating because it kind of makes me think that there's a sort of a new version of a vendor being formed in financial services in some ways. Because if you think about it, historically, if you were a bank and you wanted help mapping out your workflows and figuring out like, God, my employees keep getting stuck here, or I'm spending way too much in terms of staffing on this, like what's going on here? Who would you hire? You would hire McKinsey, BCG, Accenture. If you were a smaller organization, there are more like specialty firms that focus on like community banks.
A professional service firm is what we call this industry.
You would hire a professional services firm, and they would do roughly what these AI companies are doing. They would send people to embed themselves in your company. They would talk to people, they'd learn the workflows, and then the output of that would be like a set of recommendations, a 6-month project engagement, hiring them to augment your staff to do X, Y, or Z. But like that is really bespoke. It's driven entirely by humans. It doesn't scale very well, and it's very expensive, right? So that's one model for how vendors can engage with banks or with credit unions. The other model is buying software from an FIS or a Fiserv or whomever. And that is like cheaper, more scalable. It usually is more like automated and helps you like kind of gain efficiencies that way. But the trade-off is you're buying this very generic and very sort of unintelligent bit of software that's going to help with one component, but it's not going to like dramatically transform your business, right? No one is buying a new core system and they're like, oh my gosh, all of a sudden my entire business has changed. That's why, banks don't upgrade their core systems, right? Is that like, it's not really going to change their business in any meaningful way. But now what we have is AI companies that are doing the embedded, learn your workflow, tailor it to exactly what you're doing thing that professional services firms were doing.
Right.
But the output is software that can run in an automated fashion and it can scale. And so you're sort of seeing the blending of these two business models together into what I think is a fundamentally different type of financial services vendor.
I think that's right. And I think it is interesting to the willingness of banks to work, try to maybe basically directly, or the vendors to work directly with the labs versus develop something, wrap something. I do wonder, one, a little bit like bank sausage making, probably famously inefficient, digitized paper-based processes. Two, I think increasingly the question is what does a bank do that's proprietary, and what does a bank do that is not proprietary?
Yeah.
And, there are, I think sometimes like a process is the secret sauce. Yeah. And sometimes the process is just like what everyone has to do to achieve this outcome. Yeah. And there's something else that's proprietary. So I do kind of wonder a little bit about the close collaboration and teaching, basically teaching a company that is your vendor that could become very quickly your competitor. You can't fight it. So you might as well get maybe the efficiency from it. Well, assume that you won't be picked off and that someone else will be picked off. Yeah. But I do think that's an interesting competitive dynamic that has nothing to do actually with the efficiency and the workflow and the process itself.
I wonder a lot about that competitive dynamic. I mean, I noted with interest that you didn't see any top 5 or top 10 banks in any of these announcements. And I do think that there is this element of, if you're sufficiently big, you're going to build your own agents and you're not going to partner with someone else to build them, right? And so I think the way that a JP Morgan Chase would look at this is to say, cool, we're not necessarily going to build our own foundation model, right? Anthropic or, OpenAI or whomever, we'll still use your foundation model because those things are ridiculously expensive to train. Like not even Chase can afford to compete with Anthropic and OpenAI at that foundational model level. Like that's only a game that like 3 companies in the world play. But I think the way Chase looks at it is, or Capital One, or name your big bank, even someone like a Fifth Third. I think the way they look at it is, we believe that a lot of the value over time will not accrue at that foundational model level, but will rather accrue at the software and systems that get wrapped around those models to make them useful for these different use cases. We would prefer to control that as much as possible.
Sure.
And we don't want to share our data with these companies that are going to build this. Because like, who knows, man? Like, is it guaranteed that OpenAI is not going to become a bank in the future? Like, do we know that's not going to happen? No. We do not know that. And OpenAI has
an industrial loan charter company so that they can avoid the bank holding company.
Yeah, they cannot be a bank holding company, just as a side note. But no, they could absolutely become a bank or banking-like provider. They have 900 million users globally, right? Like that's a lot of free users. Most of them are free, who they have to monetize some way. Like they're going to look at selling financial services. So you don't necessarily want to teach these AI labs how banking works if you're Chase, Capital One, Fifth Third, whoever. But if you go down a level, you find a different class of companies. And, I think the way Customers Banks looks at it, just as one example, because they're focused on like working with OpenAI to enable faster commercial lending, faster commercial deposit account opening, stuff like that. I think the KYC financial crime stuff is a really interesting use case for agentic AI. I think the way that these smaller institutions look at it is, look, there's no competitive concern we have, right? Like if OpenAI comes into this market, like they're not going to be competing with us. Like this is just not, like we don't worry about the competitive angle. What we worry about is we are not going to be as good as a Chase or a Capital One or a Fifth Third at wrapping these models ourselves. And so we want to partner with the experts, and like no one knows how to wrap things around these models better than OpenAI and Anthropic. We want to partner with those companies to do that. And I think roughly speaking, the cores are in the same position where it's like, I think the cores are scared to death that same like AI gets rid of your moat thing that's happening to lots of other companies in the economy where their stocks are going down as AI becomes more popular. I think the cores are scared to death that their investors will wake up one day and be like, is there any moat around a core banking system in the age of agentic AI? And they want to get ahead of that concern, which is, I think, why they're doing this. But again, they might be signing their own death warrants, right? Like, is this going to allow, just as an example, like, will this allow Anthropic to sort of functionally shunt aside the cores and become like, I saw this really interesting piece, I think it was Andreessen Horowitz who wrote it actually, where they were talking about system of record versus system of intelligence and like the distinction between those two. And the theory was that system of record is a really sticky position to occupy in the stack that's just like really hard to get rid of. That's why the cores are so enduringly just around and profitable and why they exist. And wondering if AI might create like an alternative parallel system of intelligence layer where more of the value and stickiness accrues relative to system of record. And I don't know that I've formed a solid opinion yet on whether that's a good thesis or not. But even the idea that that's a theory that could happen really scares FIS, Fiserv, Jack Henry. So I think that's why you're seeing this level of aggressive movement.
Well, I mean, we've talked a lot about the opportunity. We talked a little about the competitive threat. But, the other thing, too, is the risks that AI poses and how that's kind of being managed and discussed. I'm sure that all of our listeners have heard of Mythos.
Yes.
And
they've heard the myth of Mythos. Yeah.
Yeah. And it sounds bad. It doesn't sound great. And it's funny to think like, oh my gosh, all the efficiencies. This is so wonderful. Digitize all these processes. Get the agents to help open the accounts. And then to be like, oh, cool. Like, but also you found this like vulnerability. Any actor could probably exploit it. And now we need a lot of collaboration. And it seems like there's nothing we can do because the model already exists. Godzilla already exists. We just kind of have to live with Godzilla.
Oppenheimer Oppenheimer's invented the nuclear weapon and now we can't go back. it gets compared to that stuff a lot, right? I mean, again, just for listeners for context, I mean, the Mythos thing, it's scary because it's this new model that Anthropic comes out with. And like in one pass, it was able to scan through software code that exists inside of every system in the world, right? Like every system, every part of the internet runs on really the same kind of core set of software code that has been extensively tested by humans for decades and decades and decades. Like this is not brand new software. This is like battle tested software where, thousands of humans have poured over it for decades looking for every possible vulnerability and trying to patch that. And the idea that you could invent a model that in one pass could look through that code and find staggering security vulnerabilities that all those humans missed.
Yeah.
That's as scary as it comes, right? And I think the thing that's interesting about it is just from like a sort of kind of how is AI going to reshape kind of the market and regulation and all this stuff. I think it's fascinating that, great. Anthropic decided not to release this model. They decided instead to create, I think Project Glasswing is what it's called, which is like getting a bunch of large private companies together in a very trusted, closed environment to use this model to test all their software and to find all the vulnerabilities and to get ahead of this problem. Clearly, Anthropic has looped in the government. We know, for example, that Scott Bessent convened sort of an emergency meeting at Treasury with banking regulators, called all the folks in to like talk about that. It's great that happened, but that happened because Anthropic decided to be responsible about this model.
Yeah.
They were not legally required to do that. They didn't have to do that. There's a alternate universe in which either they didn't do that or this new model was invented by one of the other AI labs, maybe OpenAI, who was a little less careful with it.
Or another country's
well, right, like China,
company.
I mean, like this is a thing, and so I do think we are probably headed to a world where the most cutting edge foundational models, the ones that are like out on the frontier, are ones that we don't know about, we don't get access to, we've never heard of, but that the AI labs are using, the government maybe it knows about it, is using, hopefully, and maybe some companies have access to, but like there'll be a very, I think, big division in the future between haves and have-nots as it relates to like frontier AI models with these scary capabilities, and then the ones that the market at large gets access to. Because if this is what the newest type of model can do, I mean, you're going to have to like not just release it as soon as it's done. I mean, this is scary stuff.
I'm kind of reminded when, it's like also when the atomic bomb was invented, and we were just like, like who gets to say in on this? And do we need like a UN, or do we need like a Security Council, or do we need like a NATO, or, or do we separately need like an accountability framework that says if you release something like this and it is used in this way, you will be held responsible for that. And now you will have different incentives around development or vetting or proofing and like, I kind of think like, it's a long running joke. I did talk about it on Breaking Banks. So now I feel like I need to write a newsletter about it, but like, it's not a crime. Like there's no crimes. You should commit more crimes because like the only thing stopping you is you. But we live in this world with no like accountability framework, or the accountability framework isn't accessed.
Well, that's the thing. I mean, Anthropic is known for being the more safety conscious AI lab.
We should not rely on these corporate overlords to be good, to be ethical.
I mean, when I saw the Mythos thing, that was the first time when I was like, oh, where this goes is the AI labs get nationalized by the government. That's what's going to happen. I mean, like, honestly, like, that's the only, and I mean, you and I sometimes joke about, like, you being a capitalist and me being a socialist on this podcast.
Yeah, you're nationalist.
Yeah, and like, it's a funny joke. I'm really not, but I think there are exceptions. And, like, this is one where I just don't see how the entire approach we have to regulating AI, it's just going to need to completely change and be very different than how we regulate other industries, because of the scope of what it's capable of. Which brings me to one other thing I wanted to mention on this topic, Kiah, which is Did you see that the agencies, the Fed, the OCC, and the FDIC released updated model risk management guidance?
I saw it. I didn't click on it. Model risk management had been something I wanted to write about before AI. And then once AI came out, I was like, oh, this is none of my business anymore. But yes, I saw that you have some feelings about it, actually.
I do. I mean, so model risk management, is a very sort of well-established, I think the guidance that we had been working off of before was originally created in like 2011. So we've had it for a while.
Right.
And, the premise is really just that like organizationally as a bank, you should set up a distinct part of your organization that is responsible for validating and testing these models. And you have to document your findings in a specific way. You have to sort of test and validate that these models will work the way that you expect them to in a very specific way. And the guidance is unusual, I think, for federal regulatory guidance in that it is pretty prescriptive and specific, whereas a lot of other guidance is more like principles-based and not specific. And, oftentimes banks will sort of be mad about like prescriptive guidance where they're like, don't tell us how to do our job.
They're mad when it's prescriptive, but when it's not prescriptive, they want it to be
prescriptive.
prescriptive.
Well, right, exactly. So they're always complaining about something. And I had actually heard from a lot of folks who work in kind of credit risk and model risk governance that despite that constant concern or constant complaint, they actually kind of appreciated and liked the model risk management framework that we had, right?
Yeah.
Like it's kind of prescriptive and specific, but like it's all logical. It's how you would want to run your sort of risk management for this anyway. If you're the model risk management team, it sort of gives you cover if you have to say no to the business. Like, well, hey, why aren't you allowing us to do this? Well, the model risk management guidance says we have to, blah, blah, blah. So It's actually not despised, I guess, among like banks when they have to comply with it. And yet, seemingly somewhat of their own accord, the regulatory agencies released new guidance that had a couple of interesting effects from what I can tell. One is they really flipped it from being prescriptive to being much more principles-based. So now we're flipping to the principle-based side of regulatory guidance. The guidance itself is much shorter than the old guidance that it replaces.
I always notice when something is shorter than the
page
previous.
Length, it matters, right? For just assessing rules. So it's shorter. It also, they went out of their way to make it clear that not complying with this guidance isn't by itself going to be an excuse for supervisory scrutiny or criticism, which is
guidance
always
is guidance.
Yeah, so now we have toothless guidance as it relates to model risk management. And then most interestingly, it purposefully took out of scope generative AI and large language models, which I have to say, I mean, at a time when banks are and their vendors sprinting towards LLMs and generative AI as fast as they can, it seems odd to me to specifically take out of scope your updated model risk management framework, this new technology. And not only that, but like they've said, oh yeah, we're going to do an RFI where we're going to gather input and eventually maybe come out with new guidance specific to large language models and generative AI. Great. When is that going to happen? How long is that going to happen? Will Anthropic have released a model that destroys the world before you get to doing that RFI? Like, are you paying attention to how fast this is changing? Like, we don't have time for that. And I find it really strange. And I will say, like, there were several parts of the guidance that were kind of a tough fit with the way that, like, LLMs and transformer models
it was kind of
work.
becoming rigid and inflexible. And because it just didn't imagine this.
Yes, and that is definitely correct. But I will also say, and I'm trying to find the right way to express this idea, there were sort of principles encoded in the prescriptive guidance that we had before that weren't super compatible with LLMs and generative AI. But what that might mean is that the principles they were designed to focus on aren't compatible with generative AI and LLMs. I'll give you an example.
Okay.
Testing models, one of the things you have to make sure is you can replicate the results of a model. So if you design the model and you're like, it does this, you put this in, you get this out, that's what it's for. And then you hand it to the team that's responsible for testing it, and they test it and they can't replicate your results, that is a problem because you don't want models behaving unpredictably, right? Like,
there's a whole replication crisis in the social sciences.
Right.
And replication in some situations is the thing we actually need,
Right.
right?
Like
should be the objective.
There's like, science-based like evidence, like we want replicability. And so that was one of the things that was sort of encoded in the old model risk management guidance.
Right.
The criticism you might have is, well, yeah, but that's not how LLMs and like generative AI work. They're probabilistic. They don't do that. And the question I would have would be like, okay, then maybe we shouldn't use those models in financial services. Like maybe the answer is to push back on the use of these models, at least in certain use cases, rather than just going, no, it's not compatible with it, so we're going to take it out of scope of the guidance. Like it seems like the problem they diagnosed was the way this technology worked doesn't fit with the guidance. But the prescription they had for that problem is, we will take this out of scope of the guidance, not, hey, we should keep this model away from these use cases. So Michelle Bowman gave a speech where she touched on AI and talked about AI. And in the speech, she really emphasized, well, we can't stand in the way of innovation. Like, we can't stop this innovation.
That is like a common refrain from the regulators.
It is.
Yes.
It is these days. And I find that specifically with AI, that mindset concerns me because like we don't know how these things work. I mean, like you catch these AI lab operators and people who are building these models, these data scientists, in a moment of honesty, they'll tell you they don't understand how it works or like why it's doing what it's doing. So I don't know that innovation around an area where no one, not even the people building these things, really understand how it works. I'm not sure prioritizing innovation is the right thing to do there. So we'll see how that works out.
I will say you are also a kind of low-key agreeing with another comment I made last week or earlier this week at Breaking Banks, which is like, hey, just a quick temp check. The regulators are pro-innovation. They are not standing in the way of it. And so when you banks are talking about kind of risk appetite, just kind of know that like where there might have been maybe some alignment or your regulators were more sensitive to risk, less interested in innovation. That's switched. Kind of, at least in the public comments, at the top. And so, to understand that you're, like, I was saying like bowling with the bumpers down, like when the regulator had provided these guardrails and you just ran into them and you were frustrated that you were running into them. Now you're not going to run into them and you can just gutter ball, right? And so to kind of really understand this dynamic, I will also say you are making a compelling argument for a long-running thing that I really want to see exist, which is more standard-setting groups. I think that model risk management guidance from these federal banking agencies put out months after, and they have to go through this kind of comment period.
Well, they technically do if the administration decides to follow those rules. Not all of not everyone in the administration follows those rules all the times, but yes, theoretically.
What if we had a NIST type organization or an AICPA type organization that was putting together standards and guidance and that was like kind of responsive and was collaborative between private and public and all different size institutions, and they kind of came up with kind of workable, like something that I think is workable and doesn't have like the force of regulation. Doesn't seem like, to your point, like the regulators like, come on, you can't just like get rid of this or say it's out of scope. What if there's this whole other group that was like, hey, we understand that AI models are challenging your model risk management process. Here's a new way to do model risk management for agentic AI models or for LLM models that you're using. And replicability is like, maybe we don't do full replicability like one-to-one, but like we could do directionally correct, or we could be like we need to be assessing when the model produces two different results, the differences between those results and weighting their significance, right? Like it's kind of like your margin of error in a poll, right? And I want that to exist. I think NIST could do it. I think AICPA could do it. I think some banking trade groups that are less interested in fighting political battles and are more interested in actually helping their banks could do it. I think state regulatory agencies could do it. I really want this to exist. It doesn't exist, and it's very frustrating. And I do not think that the way we produce these things is going to work in this like increasingly complicated tech innovation, pace of change environment, and like the process itself by which these pieces of paper are generated, these PDFs are generated, these reports, is not going to work.
Well, I think that's right. And I think just to close out on that, I mean, I actually don't mind principles-based guidance, because you're right. Like, especially when you're setting these very like technical standards that relate to like a fast moving technology that's evolving all the time. Like, this is why in open banking, they don't want regulators setting the technical specifications for how open banking should work.
Yeah, I like that. I like the idea of FDX, right?
Yeah. So I mean, like, my critique of the model risk management guidance is making it toothless, right? Like, principles based is fine. Principles based with no teeth, not so fine. But I think
it's use your best judgment. Do what's right for you, right? Everyone's finding their own path.
When has that ever gone wrong?
I think for some banks, like, that's worse. Some banks, like small banks, they literally are like, just tell me what to do. I can't be making this up on my own.
And I can't tell you the number of folks I've talked to who work in credit risk who are like, we didn't ask for this. Why is this happening? Like, just like, we like this. Like, I've heard many folks in credit risk be like, we actually don't think the existing model risk management guidance that we had is incompatible with AI or generative AI. We think that it poses some hard questions that we should be holding ourselves responsible for answering, which goes back to your point about standards. And I will say, you mentioned Affirm earlier. They're starting to work on these transformer-based architectures for their underwriting models. They're as sharp as it comes on this stuff. And I've talked to Max Levchin at Affirm, and the way he describes it is, look, replicability with transformer-based architectures is just a math problem that we have to solve. It's a solvable problem. It requires us to do things a little bit differently. We are going to probably care more about it in financial services because replicability is more important to us than it is to, OpenAI when they're building the next version of ChatGPT. Like, it's not going to be important for every use case, but for ours it is. And like, I think you could get a standard setting body together. Go get some folks from Affirm. Go get some folks from Capital One. Like, get folks who are really sharp on this stuff. Yeah. And just like build an industry standard for this is how we solve for the principles that are important. Explainability, replicability. Like, these things are encoded in fair lending laws and like things that aren't going to change. We need to figure out how to make them square with this new technology. And I feel like that's a solvable problem, which is why I'm kind of frustrated that it doesn't exist right now.
Well, we spoke about AI for a while.
We did.
And so I'm going to skip to you telling me about the biggest and yet dumbest news in banking for the last couple of weeks.
I entered this topic reluctantly, but
me too. I mean, I'm not happy about it either. I know. I hate that this is our burden to bear.
It really is. It really is. Yeah, this feels like when I asked you about tokenized deposits, and you're like, why? So all right, I'll do my best. As listeners probably know, we have the Genius Act, which regulates payment stablecoins in the U.S. It was the subject of a great deal of lobbying and fighting between banks and the crypto lobby. Although I still maintain that the banking lobby got involved a little too late in the Genius Act and didn't maybe get everything that they wanted expressed about payment stablecoins by the time that act was finalized and signed into law. So one of the things that was a gap in that law was a loophole that allowed for payment stablecoins to pay yield, much like a savings account would, or a money market fund. And the act, interestingly, did outlaw stablecoin issuers themselves offering yield. So like Circle can't offer yield on USDC, as an example. But the problem is Circle has a distribution partnership with Coinbase. And it's kind of an outrageous deal, actually, because Coinbase makes more money distributing USDC than Circle makes on USDC. Apparently, Coinbase actually has the option to extend it beyond its current one, which, like, newsflash, they're picking up that option. But, it's an interesting thing because Coinbase is the economic actor in the market that has the greatest stake in the adoption of USDC, much more than Circle does, economically speaking. And Coinbase under Genius is not restricted from being able to offer yield. So today you can get whatever 3%, 3.5% on your USDC held on Coinbase. And Coinbase is the one that pays that out to you. Banks don't like this. They view this as a huge competitive threat. They think it's going to take money out of banking. It's going to cause deposit displacement.
They think it's going to take more money because this already exists.
So question mark, put a little pin in that because question mark, like Coinbase has been doing this, PayPal has been doing this.
Yeah, I'm under the impression this is the current operating environment.
It is.
We've been cool with it for a bit,
for a while
hot second.
Yep. So it's been around for a while. So put a pin in that because that's a great question. So the theory by banks is that if they don't stop this, then everyone will offer a stablecoin, and all of those stablecoins will have yield. And if all of those stablecoins offer yield, all of the deposits that are held by banks, particularly those poor community banks that do all the lending to Main Street businesses, which, by the way, is an argument I'm actually sympathetic to, that all the deposits will get sucked out of those banks and we'll have this like lending crisis because all the money will be held functionally by narrow banks that are holding reserves for stablecoins. That's the concern. So where do we have this fight now that Genius Act has passed? Well, we jump over to the Clarity Act, which is the second piece of crypto legislation that Congress has been working on. This is sort of designed to be like market structure legislation for all of crypto. So it's not just stablecoins, it's sort of all kinds of different things, like who's going to regulate crypto as an asset? Is it a security? Is it a commodity? How does DeFi work? How do we regulate like KYC and anti-money laundering laws when people are using DeFi applications to manage their own money in a self-hosted fashion? Like all these kinds of questions.
Yeah.
However, both the crypto lobby and the bank lobby see an opportunity to resolve this sort of yield question that Genius left in this legislation. So we have been arguing about this for months and months and months. It appears from my vantage point to be a fight between the banking lobby, which seems pretty lockstep on it, I will say, versus Coinbase specifically. Brian Armstrong is like the Jon Snow meme where he's standing there with his sword and he is trying to stop all the banks from preventing stablecoins from coming with yield. So it's been the subject of like ongoing debates. I think people on the banking committee in the Senate are like losing their minds.
It's the most important political issue we face as a country,
right? It seems to be. If you were to judge based on the level of like lobbying and activity happening on Congress and even the White House getting involved in it, this is the issue. Apparently the latest on this, and this is Brendan Peterson reporting from Punchbowl News because he's been plugged into all of this, is that a couple of senators have come up with what they think is compromise language that would prohibit the payment of rewards on stable coins if it is economically or functionally equivalent to the payment of interest or yield on an interest-bearing bank deposit. Basically, what it does is it splits it up into two things, right? So if the yield that's being offered looks or smells like interest on a deposit account, it is prohibited. Instead, if it is interest or if it's yield that's offered as a reward for transaction activity, basically the equivalent to cashback rewards on a credit card,
interchange,
then it's allowed. So they're trying to sort of stake this like middle ground. Now, the problem is that is very vague. Like if it looks like, if it appears this way. Now, what do we know, Kiah Haslett, about administrative law in this country as it relates to regulation and vague regulations?
Oh, I think the Supreme Court hates that idea.
They weighed in on that, And so now, theoretically, courts are not supposed to pay any deference to regulators who are interpreting vague statutes at all. That would seem to me to be an issue with the way they're trying to sort of thread the needle on this compromise.
A small one.
Apparently, and I think this tells you all you need to know about kind of the current status of this, this compromise is acceptable to Brian Armstrong at Coinbase. Coinbase has gotten behind this compromise.
I feel like he has his fingers crossed behind his back. You know what I mean?
And
like
I think you're exactly right, because I think functionally what this compromise is designed to do is to say, all right, if you interpret it one way, you could look at it as this prevents yield. But I think what Brian Armstrong and Coinbase and the crypto lobby are sort of betting on is we think the way this will be interpreted by regulators when they put the rules together will allow us to functionally continue to do what we do. Now, banks aren't stupid. The banking lobby isn't stupid. They see Brian Armstrong getting on board with this. And shockingly, they have come out against this compromise.
I feel like it's getting so personal that they just can't ever... Like, compromise is becoming impossible because whatever he wants, they can't agree with, right? Like, that's always going to be the dynamic, is I just professionally have to disagree with you. Exactly.
Like, if Brian thinks this is a good idea, I think this is a bad idea, is I think kind of roughly where we've gotten to. And so it is a challenge, I think, that we don't know how it's going to resolve, right? This is getting marked up as we speak. The crypto lobby is trying to push it through. Banks are still expressing concerns about it. So it's a little unclear. I do think it's entirely possible that banks have gotten to a point where they're just not going to be able to like fight back against this anymore. I think they may have exhausted whatever like political will or strength they have. That's just my sort of reading between the lines. The senators who are working on this seem exhausted and just like they never want to talk about stablecoin yield ever again. Seems to be where they're getting to.
My notes in the outline is I did not ask for this. I do not want this. It would be very funny if we can't get this done before the midterms.
Yeah.
And it like
where the political calculus
hard.
may change. Yeah, right.
But I do agree with you that banks have, what this whole fight tells me is that banks have lost so much political capital to crypto as like a sympathetic group that gets their way. And like maybe this was like also kind of like a Durbin, like you lost the Durbin fight.
Yeah.
And at the same time, like I also am like, haven't you gotten enough?
Yeah.
Like the capital rules have changed. You can do leverage lending to your heart's desire. There's no such thing as model risk management anymore or whatever.
CFPB? What's
like,
CFPB?
We are shrinking our federal banking agencies by 20%. Like,
you wrote about that.
Don't, like, what is left on the wish list? Also, and I hate to be like this, like, my whole question is, like, don't we already live in the world where stablecoins get yield? And so, like,
let's talk about that.
Hey, do we have, like, an idea of, like, how big of a competitive threat this is today?
Yeah.
Like, are we looking at that? And then also, I'm under the impression, like, the crypto vote is, like, less than 10% of the population. This is truly minority rule. I cannot believe this topic that, like, only, like, less than 10% of the voting populace cares about is the banks care about this, Congress cares about this. We have so many problems in the world. Like, gas is above $4. And you want to tell me we need to talk about this issue more? Just pass the damn bill. Who cares? Like, we live in the world. Figure it out. Like, I hate to be like this. You can't get your way all the time. And you should have fought harder at the beginning because now I live in this stupid world where genius passed. Yep. And, like, whatever. I'm so over it. I'm so, like, I just kind of can't believe that we like spend any time on this still. I can't believe this is the biggest news in respective industries.
It is. I mean, it's like, the banking reporters on Capitol Hill are just scrambling every day trying to figure out what the hell's going on because it is the biggest story. And I couldn't agree more. I mean, I think, the thing that I struggle with is just let's be honest about a couple of things. There is no way to stop stablecoins from offering yield. And the reason I say that is, let's imagine that banks got exactly what they want. Okay. Well, I open up an app, a fintech app that has stablecoins built in. And the stablecoins, the Genius regulated, Clarity regulated stablecoin is in my app, and it doesn't pay any yield. It's just like a checking account, no yield. It's just sit there. That's where my operating funds are. Yeah. It's like, there it is. It's not FDIC insured, but theoretically, stablecoins are safe, so we'll be fine. But sitting right next to that account in the same app is a different account, which is my savings account. And my savings account, I can just push a button and I can transfer funds from my checking account, which sits in stablecoins, to my savings account. Now, to an end user, that's going to look and feel exactly like transferring money in your bank from your checking account to your savings account. It's going to look and feel exactly the same. But what can happen under the surface is your stablecoins can get moved into a different token that can then be farmed out using yield farming in DeFi to go earn me 10% interest. It is going to look exactly like checking to savings, but under the surface, it's going to be regulated stablecoin to DeFi. The consumer protections will change. All of the things will change. The consumer will have no idea. And because stablecoins are on chain, they are compatible with all of that. Like, the money can move from one to the other. So I don't, like, if the concern is stablecoins absolutely 100% cannot have yield in any fashion that consumers can access, we don't live in that world. DeFi exists. There's no way to stop that. To your point, this already exists. I have seen no evidence to suggest that banks have lost deposits to Coinbase or to PayPal or to people who are already paying this yield. And then the third thing I just want to talk through real fast with you, Kiah, if I may, is this Walmart example. Have you heard this one?
No, I don't think so.
Okay. I had James Westrickham on my podcast a long time ago talking about, well, how could stablecoins be used in a domestic capacity? And one of the examples he gave was, well, you could use stablecoins, if you were a large merchant or retailer, as sort of a replacement to prepaid for your own like kind of in-store currency, right? And so
Sure.
the theory would be something like Walmart launches its own stablecoin that offers rewards. And this is like the big fear that everyone in banking has is, it always comes back to Walmart at the end of the day. And so they're afraid that stablecoin plus Walmart equals all of my deposits leaving, especially if that stablecoin can pay interest, right? So that's the concern. Here are the questions I have about this, and I'll run through them in no order. It's so funny because I ask these questions to everyone who brings up this concern, and I've not gotten an answer from anyone. So maybe folks listening to this can answer these questions. Question number 1: the Genius Act restricts non-banks from issuing stablecoins. So you are not allowed under the Genius Act to issue a stablecoin if a majority of your business is outside of financial services, like Walmart, for example. So the question is, are we just assuming that Walmart has a way around that? There is apparently a exception that you can be granted, but it has to be approved by all banking regulators. Are we just assuming, that the Amazons and Walmarts of the world, if they want to launch a stablecoin, get approved in order to do that under Genius? I don't think that's a safe assumption. So that's question number 1. Question number 2. Walmart already offers a savings account with a 3.35% APY. Has that account led to a significant outflow of deposits from community banks? If it hasn't, why do we think stablecoins offering a similar yield would have a different effect? What is it about stablecoins that would have that effect? Next question. Why would Walmart switch from its current stack that it uses to enable that, which is banking as a service provided by Coastal and Lead Bank, to a stablecoin? Aren't the underlying economics, meaning what you can use the reserves for, worse, meaning less profitable for stablecoins than they are for BaaS? I mean, BaaS banks can lend out these deposits. Stablecoin issuers can't. They just have to invest them in treasuries. What benefits do stablecoins as infrastructure provide to Walmart that would be more compelling over the long term than the banking partnerships that it already has? And then finally, the Durbin Amendment, which we already referenced, unintentionally created a moat for community banks to win in banking as a service, which arguably has helped them hang on to some deposits, right? Because they're able to offer Durbin exempt interchange for fintechs that they partner with. Could a better solution to this whole thing be if you are specifically concerned about community banks? And again, all the banking lobbies are all aligned on this issue, but I wonder if there's a difference between like the Bank Policy Institute versus, ICBA in terms of this question. Could you create a similar mechanism to encourage stablecoin issuers to keep their reserves with community banks instead of big banks when they're doing custody or allowing crypto companies to get their own national trust bank charters, which we've talked about in the past? Like, is there a way to artificially improve the competitiveness of community banks as bank partners in the stablecoin universe rather than continuing to have this stupid fight about yield? Those are my questions.
This is like a super hot take, I think, for banking, but that Walmart should reapply for an industrial loan charter.
They could maybe jam it through this.
Not because I think that they should or shouldn't, but this is more of an observation that the attitude of specifically the FDIC and maybe one of 6 of the ILC issuing states may have changed. There may be willingness. And also it's an observation that the salience, I think, of Walmart as a competitor has lessened as Amazon has become more dominant. And so, and third, an observation that Walmart wants to serve a demographic of customer that is very hard for many banks to serve. It's kind of like, they might be like a Chime style customer base.
Do you think that's why Walmart bothers community banks in particular, is the overlap of like rural communities? Because I've always wondered that. Because like Amazon doesn't come up as much in these conversations. It's weird, right? Because like Amazon arguably is a bigger competitive threat than Walmart. But when I talk to community bankers, they're not scared of Amazon. They're scared of Walmart. And I wonder why that is.
So I've been trying to write, and this is like a little hard because it predates my time in the industry, but that I want to go back and do a retrospective of Walmart's application for an ILC in 2005 and 6, and then kind of like understand the environment at the time and what Walmart was kind of doing in some of these cities and how it was changing its local environment, and that the banks understood that Walmart has a national distribution network. And so that like they were going to be able to compete in every city that there is a Walmart. But then the world changed. Now we have fintechs, now we have online banking, and we have Amazon. And Walmart has a fintech. Walmart has banking as a service partners. Walmart offers many financial services. I again, because we have just a shocking lack of data about any of these competitive elements, I would like to know, does Walmart pose a bigger threat to community bank as far as payment, deposits, taking the relationship versus stablecoin, right? Because again, stablecoin is taking up so much attention that is that properly directed? Should you be worried about Walmart, but instead of worrying about stablecoin? And so I feel like your question number one, to my point, is that they should just apply for industrial loan charter bank. I would say to your question number 3, community banks should not take the reserves of the stablecoins, because we know that stablecoin reserves make a bank narrower.
Yep.
And so what would be really, really, really funny and ironic is if you put in this competitive protection and dictated that banks under $10 billion have to be the reserve partner of like a Coinbase or of a Circle or PayPal coin, that bank actually became narrower because they can't lend out their deposits anymore. Banks are worried that like they'll lose deposits and not be able to lend out, but the concern actually should be if not instead of, in addition to, that taking on stablecoin reserves makes a bank narrower, and that is also separately bad. You just have to make sure, or you have to make sure you make up for that, or you have to put in reciprocals.
It's funny. That's the concern that I think is sort of misplaced with this whole debate, is like banks think their problem is yield-bearing stablecoins. Their actual problem is regulators embracing narrow banking, right? So like it's sort of a different way of thinking about the same thing.
Master account, yeah.
Yeah, but it's hard, right? Because the banking lobby, I think, has seized on this idea that stablecoin yields equal taking lending out of rural communities. And that's a very resonant message with senators. Arguing about narrow banking is so abstract that I think it's a harder argument to make. But I think that's actually the animating force behind why banks are so pissed about stablecoins, just as a general movement right now, is because they don't like narrow banking. And they think that narrow banking is sort of fundamentally at odds with their model, which it is. Although I will also say the other thing that's interesting about the Genius Act is it allows you to store your money in multiple different places, right? Like different types of assets. You can store it in short-term treasuries. You can invest it in short-term treasuries or repos. You can also put it in bank deposits. And so I do wonder if an equilibrium that may happen over time, perhaps. The other thing you have to remember with stablecoins is stablecoins work well right now because interest rates are high. It's very rate sensitive. We don't know how attractive stablecoins are as a business or even as infrastructure if interest rates aren't high. And so I do wonder if over time what you might see is stablecoin reserves sort of migrate to some degree out of treasuries and more into deposits, because, those are treated as equivalents under the Genius Act, even though today the appeal is doing it directly in treasuries because you get sort of a premium on that. That might not always be the case. And so I do think, much like anything, like we don't always know how different models that regulators sort of bless from a policy or a passing new laws perspective, we don't always know how those models end up performing cyclically across time, right? So like stablecoins are a phenomenon that really grew up in a high interest rate environment. And we don't know what it looks like when the macro environment changes. So I think that's the other kind of unknown question. Okay, Kiah, one thing before we go, I want to get your super quick take on 2 banking/banking adjacent topics that I am personally sort of obsessed with. But I was like, as I was learning about them, researching them, writing them, in my head, I was like, I really want Kiah's take. Are you ready?
Yeah, go ahead.
I have a silly one and a serious one. The silly one first. Did you see that Lending Club is rebranding to Happen Bank?
I did see this.
Okay, you have a take. I know you have a take. What's your take?
My take is that I feel really bad for any company that wants to do a rebrand, because rebrands are hard,
They
because
are.
everyone's going to hate what you came up with, and it's going to be lame and cringy. And especially with bank names, like I really need to write my piece about bank names, but especially with bank names, there's like a type of like, there's like a theme of earnestness, trustworthiness, nationalism, weirdly.
Yeah.
And then signaling that it's old somehow. You won't get all of those. You can't often like pick all of those. And so it like, there's just no winning. Everyone was just used to the word Lending Club. It didn't matter.
It's a stupid name.
matter.
It's a stupid
if
name
it like,
too. Yeah.
Right. It was also stupid. It doesn't matter if that's like not their business model anymore. We were all just used to it. And so for them to pick literally any name,
Yeah.
they were not gonna win. And this reminds me of BB&T and SunTrust.
Yeah.
When they merged, they created Truist.
Mhm.
And the name was panned. And I read somewhere that an executive was like, yeah, we just wanted a name that like most people who like are bank customers or people in the cities where we bank, they felt neutral to slightly positive about it. And we didn't want something that was like clearly negative. And I think about how I feel like very neutral about this name now, even if at the time I was like, this is stupid. And like, again, it's that like kind of trustworthy old timey name. And I actually had an ex who was like, you should write about this bank called Truist. Have you heard about this new bank in town? Because like Nashville had changed all the like BB&T and SunTrust signs. And I was like, I like laughed so hard. He like kind of got offended, but I was like, you don't even know. And like, why would you know? But like, you can't understand the humor of like, you should like cover this new bank in town.
Yeah.
That's how, but like to me, that's how he received the name Truist. You know what I mean? And so I feel bad. I just give me like 8 months. I'm going to forget that I ever thought that Happen Bank was like stupid. And then I'll just move on with my life, right?
We'll just be used to it. Yeah, I agree. I mean, so first of all, naming is so hard. Like, it's so hard.
So hard. You've had to do it 3 times with kids,
oh,
you know?
God. I mean, and it's stressful, right? And like, I mean, I remember when I started my career in marketing, all I wanted to do from the outside was get involved in like branding projects. And then as soon as I was involved in my first one, I was like, I'm never doing that again. It's awful. It's awful work. So you're right. Everyone always hates whatever the new thing is. The old thing, they probably hated at some point, but we just got used to it. You can only hurt yourself. You can't really help yourself, I think, with naming. Yeah. My only small critique, I agree with you. Like, we're just going to get used to it the way we got used to Truist. My only small critique is it's a little too cute. Like with the whole, I think one mistake that branding folks make with this kind of stuff is like, it's like Happen Bank, the bank for making things happen. Like if you have to explain it with like a cutesy tagline that explains the name, you've overthought it a touch. So
I will say that, I don't know if you can see the background of my phone screen. Do you see what it says? It says, make it happen. I am like that kind of person, unfortunately. So as much as I don't like, as much as too cutesy and like earnest it is, like I am that kind of person about like make it happen.
So this will work.
But I'm not gonna bank at Happen Bank. I can't, right?
Well, but
it's like
I mean,
how I can't drive a Kia.
You wouldn't choose Happen Bank. Like this would not cause. That's the thing about naming is it can only hurt you. It can't help you. Like there is no. You weren't losing business because it was called Lending Club. So I struggle a bit with that, and I do think like. The best bank names are, to your point, like simple, designed to convey trust, boringness, old age. Like it's Column and Vault and First Republic, and like it's all the same. It's just the same over. First,
I wanted to come up
blah.
with an analysis of the most ironically named bank failures. Like, so like Tier 1 or like Security Bank, Security Bank, like, because the jokes kind of write themselves because of the naming conventions. But yes, I feel bad. I think you should pick like one word. Maybe the word shouldn't be a verb. Right. Maybe it should be a noun.
I agree.
Yeah.
Yeah, the verb is a little tough. It conveys action. It conveys moving forward. All right. Second story that I want to get your quick take on. Did you see PayPal's settlement with the Department of Justice? And I use the word settlement in a very loose term because this was an investigation, not a lawsuit,
and the investigation was focused on fair lending violations, and it was alleging fair lending violations for a program that PayPal started in 2020 that was designed to invest in Black and other underrepresented communities. And it was an investment fund, so there was no lending. And the settlement, I use settlement in quotes, was not a fine paid by PayPal, but rather a new program that they're going to be setting up that is going to be supporting small businesses, but only small businesses that are either veteran-owned or that are in like manufacturing, farming, or like tech. One of the parts of the settlement, ironically, is setting up a set of trainings for employees on the Equal Credit Opportunity Act, which again, just to reference, Kiah, the Equal Credit Opportunity Act applies to loans made, which PayPal was not doing. That's why, that's what fair lending laws are designed to do, is to stop discrimination in lending. So I don't know, any takes on this settlement? It struck me as a touch unusual.
My first sarcastic take is a great evil has been corrected and, prosperity on the land. My second take is words don't mean anything anymore, which is
really don't.
Pretty bad if you're in like kind of a language base, like
if you
reading
write, like,
comprehension, where like
reading
comprehension is like really important to your job. So that's bad for me. 3 is that I actually also, again, not to keep bringing up that breaking banks thing, but I mentioned this settlement on stage because, again, when bankers express, like, I kind of can't do something, my risk appetite, my regulator, I'll get in trouble. I was like, hey, so reputation risk. You like, this is what they're looking at right now. These are the fights they're fighting. These are not serious people. Their conception of like bad things and good things is so whack that it's dangerous to you from an operating perspective because it's just not predictable. This is clearly just like a fine, like, this is an amount of money to get a PR, get it to go away, stop sniffing around here. And I think, like, again, when I think about, banks, kind of what have they gotten from these agencies versus what have they not gotten? What did they vote for? What did they not vote for? Like, this is a package, right?
You get everything.
And the leopard, the face-eating leopard, ate your face, whatever. So, like, and that's something we talk about too. And so, like, I think this is bad. I think it's bad in all the ways. I don't think there's any redeeming thing about it. Like, maybe PayPal should be working with these businesses but I don't, to the extent anyone gets preferential treatment, whatever, like, that's kind of a business decision. I don't really want the government involved in that either. But I think, like, this is not good. It's not good that this came out. It's not good that the agencies care about this. It's not good that PayPal capitulated. It's like, these words do not mean what you think they mean. I also, I take this as a really big signal of like the federal agencies care about and where they will spend their time. And like I was saying on stage, like kind of facetiously, but like, so go do a little bit more crime. Like, what are you worried about? This is what they care about. Go do crime.
I agree. I mean, it's just a strange situation when, like, I was doing the research into this and I kept being like, did they break a law? Like, am I not understanding this right? Like, am I
is my understanding of the law completely different than what the law says?
Yeah. And I was like, I even asked AI at one point, I was like, can you explain this to me? Like I've looked at this. Like, did they do something wrong? And like, AI came back and was like, well, in 2020, no. In 2026, arguably. And I was like, well, what do you mean by arguably? And it's like, well, because of things like these actions happen. And it's like, right, but is it actually against the law?
No, they're making it up. And I think the dangerous thing is that they're using stuff that's written down that doesn't say that. And then like which means that like, it means that there's no consistency. It means that nothing's off the table.
It was wild because I was reading the press release and it was like, sentence 1 in the press release was like, this resolves a investigation by the Department of Justice into fair lending violations. And then the second sentence was, in relation to a investment program run by PayPal that did all of these things. And nowhere in those 2 sentences did they actually say, we think that PayPal violated fair lending laws, because they can't say that because that's factually not true. And so
Also,
they constructed this press release where like the impression is they violated ECOA, but they never actually say PayPal violated ECOA because they didn't.
The body text.
Like it's so stupid.
The CFPB used to get in trouble for making shit up, and that was a really big criticism. I think it
or putting out like they
term.
would regulate by press release or do these things that were more symbolic than
the ally settlement was problematic. And like I don't expect intellectual consistency from this administration, so like it doesn't super surprise me that they did something like they took that playbook and like did it like crazier.
Yeah. Like dialed up the like lack of reality by like
they were like they got away with it, but let's do it like slightly worse. I don't know. It's
crazy.
It's bad, Alex. It's so bad. It's bad out here and stupid.
Yeah,
that's what I always kept saying.
I wrote about it in my newsletter, and at one point in the write up, I was like, I think I'm losing my mind, and that was what happened after I like stared at this long enough. So cheerful note to end on, but I appreciate you giving me your quick take on it. I'm glad you mentioned it on stage too. That's we should just remind people this is the world we live in right now.
In conclusion, do crimes.
Yeah, apparently. All right. Well, Kiah, thank you. This was fun.
All right. Bye. See you later.